Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, May 20th, 2025. Hope you're having a fantastical day out there in the interwebs. Beautiful day here in Colorado. Sun's out, cool breeze. You should be here. Anyways, the S&P 500 snapped a six-day winning streak as rising treasury yields and debt fears weighed on the markets. Trump's tax cut bill stirred more deficit concerns, while Home Depot held strong on earnings and Moderna jumped on trial news. D-Wave Quantum soared 25% after debuting a new system, but economic signals dimmed as leading indicators fell and tornadoes continue to pummel the central U.S. It's probably global warming, I would imagine. All right, so before we break it all down, if you could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press the notification bell. All righty, well, let's hop into today's markets and see what's going on. Dow Jones finished the day down 0.27%, 114 points, closed at 42,677. S&P 500 down 0.37%, 21 points, closed at 5941. NASDAQ down 0.38%, 72 points, closed at 19,142. The VIX also down today, 0.77%. It's at 18 flat. Canada up 0.32, Brazil up 0.29, and Mexico down 0.3. Headed to Europe, Germany up 0.34%, the UK up 0.94%. France up 0.75%, Netherlands up 0.16%, Spain up 1.59%, Italy up 0.89%, Switzerland up 0.51%, and Portugal up 1 3/4. Russian exchanges red today. The MOEX down 1.86%, RTSI down 1.73%, and the overnight markets, the Nikkei in Japan was up 0.08%, Australia up 0.58%, New Zealand up 0.31%. In China, the Shanghai up 0.38, Shenzhen Component up 0.77, China A50 up 0.56, DJ Shanghai up 0.42, Hang Seng up 1.49, and the Taiwan weighted was down 1.46%. All right, so those are the markets. Awesome news. All righty, well, let's get to the market recap, see what happened. S&P 500 takes breather to remain on track to snap a six-day win streak. All right, the S&P 500 paused on Tuesday after a strong run, staying on track and to end a six-day winning streak as investors processed key retail earnings and ongoing trade developments. Despite a recent credit rating downgrade from Moody's, the index has rebounded sharply and is now within 3% of its all-time high. Retail earnings offered insight into consumer strength. Home Depot stock rose after beating quarterly revenue estimates and reaffirming its full-year forecast. Notably, the company said it doesn't plan to raise prices despite tariffs, contrasting Walmart's statement last week that it may hike prices due to cost pressures from new import duties. Investors are also awaiting Toll Brothers earnings after the market close for further housing market insight. Tesla climbed over 2% after CEO Elon Musk reaffirmed his intent to lead the company for the next 5 years, emphasizing the need for leadership stability. I see most of the time he's talking crap on Twitter. I don't know when he has time to run his businesses. On the policy front, a sweeping Trump-backed tax cut bill passed a House committee, moving closer to a full vote. The proposal includes income tax cuts and more defense and immigration spending, but faces criticism for adding to the ballooning U.S. deficit. Yeah, none of these people are going to do anything to fix our problems, and we'll probably head towards insolvency sooner than later. Meanwhile, St. Louis Fed President Alberto Musalem stated that monetary policy remains, quote, well-positioned and downplayed tariff-driven inflation as temporary, reinforcing expectations that the Fed will keep interest rates steady for now. Trade remains a focus following last week's U.S.-China tariff truce. Talks are scheduled this week with Japan, though the U.S. Treasury does not anticipate announcing new deals at the G7 Finance Summit. Tensions resurfaced after the U.S. Commerce Department warned against using Huawei chips, prompting China's Commerce Ministry to accuse Washington of undermining recent diplomatic progress and demand corrective action. In short, markets remain buoyant, but trade and fiscal policy risks continue to loom. All right, so good stuff. All right, well, let's go to our first article here from Zero Hedge. It's titled Buy Now, Pay Never. Klarna's losses double as U.S. consumers fall behind on payments. So that's good that people aren't able to make their credit obligations. Klarna, a Swedish fintech firm best known for its buy now, pay later services, reported a dramatic increase in Q1 losses, raising concerns about the financial health of U.S. consumers and sustainability of the buy now, pay later model. The company posted a $99 million net loss for the quarter ending in March, more than double the $47 million loss a year prior. Credit losses surged 17% year over year to 136 million, driven primarily by rising U.S. consumer defaults. Klarna's model of offering interest-free installment payments has gained massive traction in the U.S. through partnerships with major retailers like Walmart, eBay, and DoorDash. But the economic turbulence following recent tariff policies from President Trump, combined with inflation fears and plummeting consumer sentiment, has led the company to suspend its planned IPO. While Klarna maintains that 83% of its loan balances refresh within 3 months, credit loss as a percentage of payment volume ticked up to 0.54% from 0.51. Despite losses, revenue rose 13% to $701 million, and the platform now boasts 99 million active users. Klarna has aggressively cut costs, slashing headcount by 39% over 2 years and reducing customer service expenses by 12% year over year, even as funding costs jumped 15% to $130 million. The broader buy now, pay later industry also shows signs of strain. A LendingTree survey found that 41% of users reported late payments, up from 34% last year, with 25% now using buy now, pay later for groceries, up sharply from 14% in 2023. Gen Z leads this trend, with 1/3 using buy now, pay later for food. Meanwhile, 23% of users report juggling 3 or more buy now, pay later loans at once, highlighting growing consumer reliance on short-term credit to cover basic needs. An increasingly precarious trend for both consumers and lenders like Klarna. Well, as I've said before on more than one occasion, from my experience in the credit and collections industry before I got into doing this, is that when delinquencies go up, typically that means the economy is going down. So it's small today, but eventually it will catch up with us and bite us in the butt. All right, last article, also from Zero Hedge, Schiff on gold in a multipolar currency regime. So let's see what Mr. Schiff had to say. The U.S. dollar remains the world's dominant reserve currency for now, but rising global de-dollarization signals a shifting tide. And in its wake, gold is reemerging as the world's most trusted neutral reserve asset. Nations like China, Russia, and India are actively reducing their reliance on the dollar, favoring local currencies or gold for trade. This trend is accelerating due to soaring U.S. debt, inflation, and interest payments. Conditions have eroded confidence in the dollar's long-term stability. The dollar supremacy, born out of the Bretton Woods Agreement in 1944, is under threat from excessive U.S. borrowing, Federal Reserve balance sheet expansion, and geopolitical overreach. The U.S. debt now exceeds $36 trillion, and nearly half of new debt in 2024 was to service interest on existing obligations. Meanwhile, Treasury yields remain volatile, and trust in U.S. fiscal responsibility is waning. Central banks around the world are increasing gold reserves, especially among BRICS-aligned nations and Poland. IMF data confirms the dollar's shrinking share of global foreign exchange reserves, while gold's share has risen significantly over the past decade. Gold is increasingly seen as not just a hedge, but as a strategic, depoliticized reserve asset. At the 2024 BRICS Summit, members discussed a gold-backed trade unit directly challenging the petrodollar system. A global trust in U.S. Treasuries, as global trust in U.S. Treasuries diminishes, gold's appeal as a safe haven intensifies. Peter Schiff and others argue that a catastrophic dollar collapse looms, triggered not by war or crisis, but by the unsustainable debt and inflationary policies underpinning America's economy. As the multipolar currency regime unfolds, gold is reclaiming its historical role as the world's ultimate store of value in a future marked by stagflation, sovereign defaults, and collapsing trust in fiat currencies. Gold stands unchallenged, unchained, enduring, and indispensable. I agree. We have really painted ourselves into a corner with the fractional reserve banking that we do, and inflating the currency so much over the last few decades, and now our dollar is completely worthless, and I don't blame people for going to gold. So, All right. Well, that's everything that I had to cover for today. So if anyone wants to get in touch with me, where do you want to go? Doodle-doo-doo-doo, DSAFinancialGroup.com. All your financial planning needs can be addressed there. Give me a call. I'll be glad to help. All right. Well, hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.